I'm really excited about today's topic as it is something I've been thinking about for a long time. It's something I've been thinking about, but it's been sort of uh, precipitated by all these conversations I have with our financial services clients. Now, let me just say, while the title says to build a simplified architecture for growth in financial services, the core tenet of what I'm going to talk about today applies to all industries. So I'm going to use financial services as the backdrop. It's an industry we do a lot of work in, but is applicable to your business. It's really about how we simplify our markets and how we think about our markets in a simplifying manner. I'll use the word simplify a lot today, so just bear with me, but it's very, very important to this discussion. Jobs to be done is a simplifying economic principle. That's what it is. It's an economic principle, and it's at the core of the front end of innovation. Now, those two concepts are very important. Economic principle. It defines why customers are coming to you, the company, and it's at the front end, the very front end. Because if we get this right, our world is much simpler. We can guarantee that the stuff that we're going to actually put into product development is going to be successful. And you'll see why I can make that claim. So get this right, and it's a powerful tool for building an architecture for long-term growth. Get it wrong, however, and it can make your markets appear much more complicated than they are. So in today's discussion, I'm going to go through the following agenda. First, I'm going to briefly discuss jobs to be done thinking and why it's so powerful. Now, I'm not going to get down to the nitty gritty. I'm going to keep it pretty high level and more at the practical application level. We've written a ton on this. We've got webinars. We've got videos on this. Go to our website. There's a ton of information if you want to go deeper. I want you to understand this basic principle, though, so you can start to then apply some of this thinking in your markets. Second, we'll explore how companies overcomplicate jobs thinking and their markets in general. Third, I'm going to suggest an architecture for a simplified view of jobs to be done and financial services, including real world examples. Finally, I'll wrap up with the benefits that taking this approach will provide to you and your organization. We'll end up then at the end, as John said, you can ask some questions and I'll do my best to answer them. A little bit about me. That picture is 6 years old. As you can see, my hair's a little grayer, but that's me. My name is Rob Schade, and I've been practicing jobs thinking and implementing it through our outcome-driven innovation model for the past 20 years. I've worked on projects in a myriad of industries, but financial services is where I've done the most work, and I really love it. I've worked with leading banks, credit card companies, investment firms, and even non-traditional financial players to help them create growth strategies in financial services. I ran sales and marketing for a fintech company back in 1998. I laugh because no one called it fintech back then, but we were a technology company, a technology-led company looking for a problem for our technology. We're doing what I'm going to talk about today backwards, and we failed. Our discussion is going to be about the front end of your whole product development cycle, which is innovation. It's the process of devising solutions that address unmet customer needs. Our collective focus as innovators is to create value for customers, and the only way to do that is to provide value on needs that are unmet. And we have to figure out how to address them better. Jobs to be done is that framework to help us understand that. It's the foundation, really, of the front end of innovation. It can enable faster, more consistent growth within a market or identify entirely new markets to go after. It can also prevent disruption. I know that's a lofty claim, but let me give you an example here in a little bit. Jobs theory is also intuitively appealing, and it's simple to understand and explain to others. This is important as you, maybe perhaps an evangelist within your organization to adopt such a way of thinking, have the ability to go communicate its value to others. But don't let the simplicity mask its power. By embracing it, understanding and embracing jobs theory, an organization can use this to build a very, very stable long-term architecture for growth, one that prevents even disruption. Jobs theory really does put a new lens on innovation. Simply stated, jobs theory is an economic principle. It says that people come to companies in search of solutions to help them get a job done. It's therefore the job that should be our focus of innovation, not our products. Products are simply the vessel for the innovation at a point in time, but they're not the end all be all. The job is. Listen, no one invented jobs theory. Like I said, it's an economic principle, but Strategyn has spent 30 years perfecting the implementation of it. The power of the model comes from its ability to answer two very, very important questions. Where should we create value, and how can we create value? The where and the how. The answering of these two questions is what the front end of innovation is all about. The customer's job is what the customer is trying to achieve or accomplish. A well-defined job statement points to where the customer wants you to create value. It doesn't tell you how yet, it only tells you where. The second critical element of jobs theory, which our founder Tony Ulwick is uniquely credited with discovering and describing, is this idea of customer outcomes. Outcomes are the metrics for success that customers use to describe the perfect execution of the job. Now, for any given job, there might be 50 to 100 outcomes. These outcomes are precise, they're solution agnostic statements that the customer can easily share with you. Why? Because they're expert in the job. They're not expert in your product, but they are expert in getting the job done. And so we go and capture the information that they can tell us about, which are the outcomes on getting the job done. They know what they want to do, and they know when it goes right, and they know when it goes wrong. So again, the job statement, singular, this is very important, singular, tells us where to create value. The outcomes, many, point to how to create value in a market. If a company knows and agrees on these two elements, the job and the set of outcomes, then they have an architecture for growth for a given market long into the future. So I'm going to stress this point because this is where a lot of the problem occurs. So let's look at the architecture of this. There is the job, the one, the core functional job, the where, and there are many outcomes that describe the perfect execution of that job. The many, right? Many people confuse this concept. They think everything is a job. This is not the case. There's a core job and many outcomes. Customers don't care about your products. They don't. They care about getting their job done faster, better, and cheaper. Outcomes point to the how of getting the job done better, faster, and cheaper. Let's explore an example of how focusing on the job gives you a different perspective on a market. Now, this example is not in the financial services space. We'll get to those in a moment. It's in the rental car space, the rental car market. Now, wait a minute. We're defining the market by a product, a rental car. Let's think of Enterprise, a leader in the rental car space. They have rent-a-car in their name, Enterprise Rent-A-Car. It's a great company. They dominate the space. Their product is stated in their name. But is that their market? Are you loyal to Enterprise? Maybe. Maybe you like them as a company for rental cars. But are you loyal to the solution of rental cars? It's unlikely that you are. You see, everyone is loyal to getting the job done better, faster, and cheaper. When better solutions come, they will migrate to get to those new solutions. Let's look at the example in this space. Look at rental car usage decrease over the years, and look at ride sharing increase over those years. That's because ride sharing is just a different solution for the same underlying job. You see, Enterprise isn't in the rental car space, the rental car market. They're in the moving people, getting them to a destination without their own transportation. So taxis, rental cars, rideshare are all just solutions to helping customers get that job done. Job theory just states you should focus on that. Focus on the job. Orient around the job and understand all of the needs of that job, and you've got a model to prevent disruption. If I was Enterprise and I was really focused on that job, I might be in the ride sharing space or a entirely different solution than ride sharing, and they might have benefited from that. This is how you can disruption proof your business, because if the business is really built around the job, then you're always looking for new technologies, new ways of better satisfying that need. See, companies define their markets around products, verticals, demographics. I can't tell you how many of my financial service clients, we're working with this checking account group or the credit card group or the debit group. But those are just products. That's not a market defined by the job. So we say through the jobs to be done lens, a market is a group of people and the job they're trying to get done. The job of get to a destination without your own transportation is a much bigger market than the rental car space, right? So this step alone can have a massive impact on how your organization views its market and its growth potential. So stop focusing on your products, focus on your customer's job. So here's a financial services example. A client came to us and said, we want to innovate our savings and checking accounts. We said, fantastic, we'd love to help you. We're not going to study those. We're going to study the underlying job that those products help customers with. So what is that job that people are trying to get done with checking accounts and savings accounts and a whole host of other products? Well, through our discussions with our clients, we focused on this. We defined the market as consumers managing monthly cash flow. By focusing on this job, we were able to help them innovate their checking accounts, their savings accounts, debit cards, credit cards, short-term loans. How could we do this? Because all of those products are in service of this job. Financial firms, like many other, are incredibly siloed. Shouldn't a financial service provider be expert in this job, in understanding this job at its most granular level? Is anyone in your organization focused on this job? Is there a group of people who say, hey, I'm the product manager, I'm the job manager of manage monthly cash flow? Think of the organizational change that might happen if you were to do this. Don't you think someone should be looking after this job? You'll see why it's so important as I move on through this presentation. So this is a pretty simple theory, right? Focus on your customer's job and bring clarity to the front end of your innovation process. Open up the aperture. Look at what the bigger job actually is. It's not your product, but it's this bigger job. But people have made this simple model overly complicated. Jobs theory is a simplifying process. It's not a complicating process. It's a simplifying process. So let's make it simple. I've been in this business 20 years. Tony started Strategyn over 30 years ago. But over the past 5 years, we've seen a massive increase in companies adopting job theory. We're excited about that, and we know that's the right way to go. Like we said, it's an economic principle. It's this reorientation that gives you all of these benefits. However, when we start to talk to them, something happens. It's clear that they've got a misunderstanding about it, or at worst, they're using it or gaming it to go back to the way they used to think in a product-centric way. Here's an example of what I mean. One of our large financial institutions came to me once and said, hey, we think we help our customers with hundreds of jobs. I kind of smiled, raised my eyebrow. I said, I don't think so. I think it's something more like 6 or 8. I just made that number up, but I knew it was something radically different, and I had to communicate that to them. Well, they thought I was crazy, and the call quickly ended. They came back about 6 months later, and they go, we agree. We think it's 9 jobs. Fantastic. We agree. It's a simplifying process. It's a simplifying model. You see, everything is not a job. If it were, I'd agree with you that the financial services industry or your industry would be incredibly complex, but it's just not that true. It's just not true. So I put this number out there, 6 or 8, and they said 9. And I said, well, what are those? What are those core jobs that a financial institution should be helping their customers with? Now, I'm putting it in context of all of these conversations I've been having with our customers over time. Every conversation I had, they said, we're trying to help our customers achieve financial wellness. I go, that's very interesting. So if I do these things right, I should be able to achieve financial wellness. When I asked my clients, what is, how do you get there? What is financial wellness? Their definitions were not very good. So I said, well, let me think about this. What things must a person do to achieve financial wellness? What I did was I reviewed many of our past projects. I had great conversations with lots of our customers, and I read articles on helping people achieve financial wellness or something, achieve goals. The architecture I'm about to share with you is a result of that thinking. It's not perfect. It's a working model, but I think you're going to see how it takes what could be a very complex view of your market, if you think everything is a job, to something that is much, much simpler. So financial wellness, what is it? Well, it's a destination, isn't it? It's a state of financial security that one can achieve if they're successful in managing their financial life. Well, how do you manage your financial life? What are the things you need to do? Well, I need to develop financial goals and plans. I need to assess I need to know where I am today. I have to manage the inflows and outflows of my income. I need to sequester some and put it away to save and invest to grow wealth. I may extend spending capability via debt to do certain things in my life that I can't do immediately. I may need to protect my financial condition. I may need to, as I accumulate assets, put a wall around them to protect them a little bit. I need to maybe change my financial behaviors as I go through life, and I have these life events that really change my plans. Then I have to verify that I'm on this path to wellness. We don't do this once. We're doing this continuously. So what you see here is not hundreds of jobs, just a handful. Now, there may be 50 to 100 outcomes for each of these jobs that describe the perfect execution of each of these jobs, but they're not hundreds of jobs that a financial institution is helping their customers with. There's some core ones, and then there are a bunch of outcomes under each of them. This model is really useful for a variety of things. First of all, it helps us look at the market in totality. Like, what are the solutions that people are using to get each of these things done? This is just a short list, it's very inexhaustive, but you could certainly add to these. What's really helpful about looking at it from this perspective is, now when new competitors, be they fintech or a non-traditional player who wants to get into the space, be it Amazon or Apple or someone else, you can look at what they're doing and say, where are they actually playing? What are they actually doing? What are these jobs are they actually addressing? Now, they have no more right to success than you do. They have to follow these same rules. There's jobs and outcomes. These fintechs aren't doing new jobs. They're doing the same job. They're just doing it with different technology and different platforms. So now we have a way to analyze what others in the market are doing as well. The only competitive advantage these non-traditional or startups might have is they're not burdened with current products and platforms. However, if you reorient towards the job, you're going to start to discard that concern about those past products and services and really focus on that job. My fintech experience was we were technology driven and failed miserably, but we should be job driven to understand deeply how we can create value over time. Now, I'm going to take this model and go a step deeper. I'm going to take one of these jobs, the job of managed cash flow, and show you how you build out this model for one of those jobs. Again, I'm coming back to this hierarchy because I want to stress this, because this is where the mistakes are made. I'm looking at one core functional job, and that is the job of managed cash flow. Then I have many outcomes that describe the perfect execution of that job. So let's see what this looks like in practice. We went out and interviewed consumers, Strategyn did, and we captured 84 outcome statements across these 9 job steps. How did we do this? We just talked to them about the job of managing cash flow. They know it very well. Not any one person, but collectively over 8 or 10 or 12 interviews, we captured all of these outcome statements. Look there are 84 outcomes that describe the perfect execution of that job. We also captured 16 emotional jobs. Emotional jobs are just emotional states that people are trying to achieve or avoid as they do the core functional job. We're not going to talk about the emotional side today. We're just going to talk about the functional side. So let's go down a little bit deeper. and look at outcomes for each or for some of these steps, because I wanted to show you how this simplifying architecture pays dividends over a very, very long period of time. So the job of managing cash flow, the first step is receive money. Here's one of 12 outcomes for this step. Minimize the time it takes to verify that an amount received is what was expected. Note on each need, you will not see a solution. Nothing about checking accounts or savings accounts or credit or debit cards, just how the customer measures value for getting the job done. This frees the team from their solutions to focus on the best possible solution to help satisfy the customer needs. They're freed. They're free to think differently. How about this step? Plan spending. Minimize the time it takes to determine how much is to be spent on essential expenses in a given time period. Do you think this was a need 30 years ago? 20 years ago? How about today? How about 10 years in the future? Yes, this need is the same need that they had 30 years ago, and they're going to have 10 years, 15 years into the future. That's because outcomes based upon jobs are stable over an incredibly long period of time. Capture these needs once, use them, innovate off of them for many, many years. You only have to do this once. How about this one? Set aside money for savings and investments. Minimize the time it takes to determine how much can be saved given current spending. Now, as you read each of these statements, think about the solutions people use today to help them achieve this or satisfy this. Do they use your products or a competitor's products? Do they cobble something together to make this happen? This is a need. It needs to be satisfied. Companies satisfy it in a variety of ways. Fintechs may have a different model for satisfying it, but it's still the same job with the same set of outcomes. They play by the same rules. They just may be using a new technology or a new platform to help you get that done. But if you know the needs and you know which ones are unsatisfied, you know where to go create value, just like they do. A couple more of these. In deciding whether to spend money, that step, minimize the likelihood of spending beyond plan in a category. So are there new companies that are addressing these needs today through new technologies or new integrated platforms? How about a credit card with personally set limits on expense categories that would alert you when you're about to overspend? Now, I'm sure there's someone in this meeting today that works for a bank that is already doing this. That's good. They should be. It's a need. It may be at odds with the business model of transactions, but it's actually helping the customer achieve that financial wellness. We're putting the customer first. Here's one: use credit to make a purchase. Minimize the time it takes to determine the total cost of using debt to make a purchase. Now, for some segments of the market, this is incredibly important. They don't want to be spending too much. They may not be paying off their credit card bill every month. And so they want to reduce the amount of interest that they pay on their credit card. Enter Apple, a non-traditional financial service provider, and is taking a much more holistic, transparent view on their credit card. They're showing you how much interest you're going to pay and giving you ways to lower that interest by paying it off more quickly. Now, if Apple is successful, other card companies will have to respond. But Apple will benefit by being the first mover here. I mean, this need exists. It's how you deliver against it is what differentiates you in the market. Personally, I think there are huge opportunities to innovate in the credit card space. I think you're going to see a lot more of this happening because I think there is a movement towards debt pay down and being more responsible with debt. But just think of all the possibilities when you free yourself from your existing products. I know it's easier said than done, right? But starting from the job and set of outcomes does give you that ability to imagine what the future will look like. We had a medical device company once come to us and say, we want to look at where we're going to be disrupted. We want to look at the needs that might cause for disruption in our marketplace. So we went out, we studied the job, we got all the outcomes, we showed them where the opportunities were, we helped them create a disruptive solution. They never launched it. They just wanted it to be in place in case someone did it. That was very forward thinking on their part. But they could do that because they had these stable, long-term needs that describe the perfect execution of that job. And if their solution wasn't doing it along certain dimensions, they knew which ones it wasn't. This is the last example I'll go with today, but I wanted to show you the statement and examples for a reason, to show you that this is happening in the market naturally. So on the make a payment step, minimize the likelihood of suffering a bad consequence due to problems with making a payment. No one wants bad consequences, right? So enter PNC with their low cash mode. Say goodbye to surprise overdraft fees. Good for PNC. This is a solution that helps people say, wait, you're getting low. You have to be careful that you're not going to have any bad consequence of late payment fee based upon your balance. Now, I guarantee you other banks are doing this. I'm just showing you that the market over time will eventually uncover and address those needs. But wouldn't it be better for the organization to know what all those needs are up front? Then you're just constantly working at improving each of those needs. And you're not just doing this quick, new feature here, new feature there. You know where to go create value. But then you might say, Rob, we have 84 needs. We need focus. Where should we focus? Well, this is the easy part. Now that we've captured the needs, we're going to go quantify them. That's all. We're going to go ask, how important is that need to you today? And how well satisfied is it with the solutions that you use? See, while the need is stable over long periods of time, the priorities of those needs will change as new solutions enter the market. So you've got the stable architecture to grow for years and years and years. All you have to do is re-quantify these every 3 to 5 years. And what you do then when you're quantifying is finding those gems, those ones that are very important, but not well satisfied. See, this is what we're doing now. We're providing a very precise model to show you where the market is underserved. Go back to the definition. We're trying to devise solutions that address unmet customer needs. Well, we have to know what they are. We have to know them in totality, and we have to rate them. Now we've measured them. We know where to go create value. By doing this, we've de-risked our innovation process. The front end should be guaranteed success. Everything that we put into product development is going to be something that the market wants or a segment of the market wants. It's just our implementation is our only risk factor there. And that's downstream. The front end, we can almost eradicate the risk of doing something that the market is not going to like. We don't want you to fail fast. We want you to succeed fast. So we're not iterating all this time. We're going to look at the outcomes and know which ones we want to go invest in. But wait, not all customers are alike, so we can't stop there. We're not going to build to the average of the market because customers don't agree on which outcomes are unmet. They struggle in different ways executing the job to be done. So we're not going to segment on demographic or psychographic or attitudinal. We're going to segment on the needs because we're innovating. We're segmenting for the purposes of innovation. So while the attitudinal and the behavioral and the psychographic stuff might be interesting, it's not what we need to segment for the purposes of differentiating in the marketplace. We'll still capture some of that information, but it's not the determinant of where we innovate. So we don't want to innovate to the average because there's no one solution fits all the needs. People have different preferences in how they want to get the job satisfied. So let me use an example from my vacation last week. And John, bear with me. I'm going to do a little backpacking example. In this picture, you're going to see 3 tents. The one on the left is a copper spur 2-man tent. That's my tent. I chose it because I like more room inside. That's all. I like to roll around, and have my gear in there, what have you. It's a little heavier because it's a 2-man tent. The one to the right is a copper spur single-man tent. Nice small footprint, lighter than mine. My colleague, my friend, chose to use that one because it weighs less. The third one, the blue one up in the right corner, is a tent that has no internal frame like the 2 copper spurs. You set it up using trekking poles. It is ultra light. Now there's positives and negatives to each of these tents, but we all selected different tents based upon our preferences. One tent doesn't satisfy the whole market. nor does one checking account or one credit card, or that's why we have segmentation. So let's go look at what our market might look like. And here is a real example from one of our financial services clients. They have been in this space for 100 years. The space is helping people save for retirement. Now, you think after 100 years, the market would be perfectly satisfied, right? That's not the case. Look at this. 25% of the market is incredibly underserved. 48% of the market is appropriately served with some underservedness in that dark gray area, and then 27% is overserved. Now, this is not just their customers, this is the entire market. So a representation of the total market. Now, I can't tell you what it's going to take to satisfy those 25%, but I can tell you it's not the platforms and the solutions that people have today, because they'd avail themselves of it and they're not. So to serve this group, you're going to need a different platform. And there's fintech companies out there now that are trying to do this. But you only know this by taking a deep dive into the outcomes and then segmenting along those outcomes. Hopefully you're seeing how the simplified model of both the job, the smaller amount of jobs that you really actually serve your customer with, and having this precise understanding of the outcomes that you're going to be measured by is helping you understand how you can continuously innovate within a market. We do all of this in service of this, which is building a pipeline of opportunities to develop over years and years. So if we identified 30 opportunities of those 84 that are important and poorly satisfied, then we have some short-term opportunities that we might avail ourselves of, like better position our existing products. That's free money. That's just turning the marketing spigot on. It's optimizing marketing around the unmet needs. Or maybe it's improving our existing products, just tweaking some quickly to improve that satisfaction. Maybe more long-term, medium-term, we've got to fill gaps with new products, because we've taken a bigger perspective of our market. It's cash flow. It's not just checking or savings or credit or debit. Then we might see things that we don't have any even capabilities for. And that might require long-term investment, long-term thinking, M&A perhaps. The benefits of thinking this way are the following. I'm going to finish up here in just 2 more slides. First thing I'd like to say is it enables you to discover new opportunities in current markets. Now, why is this so important? Because you're not looking at your market from the job, you're looking at it from your product. I can't tell you how many of our clients come to me and say, we're in a commoditized business. Our market is becoming commoditized. No, your product is, the market is not. So it gives you a much bigger view of where there are opportunities in the market. We often find tons of opportunities in markets they say are commoditized. Second, align and simplify your organization around the core jobs of your customers. As I asked earlier, wouldn't it be beneficial if an organization studied this job of managing cash flow and someone owned it within the organization? Because then they'd be feeding all their different product lines the opportunities that they should be going and embedding in their solutions. Third, it brings clarity around new technologies to embrace to help you better serve customers. Don't do what I do, work on a solution, work on a technology in search of a problem. Do the other way. Figure out where all the problems are and then just look for the best technology to help you solve that problem. Again, jobs to be done should be a simplifying process, not a complicating process. You don't serve as many jobs as you think you do. And at some high level, you know what those are. You can document what those are. You can capture all of the needs, and now you've got an architecture for all of the jobs that you help your customer serve. So when we want to help our customers manage their financial life to achieve financial wellness, they're going to go through some series of steps to help them get that done. We at Strategyn have already done 3 of these projects on our own, and if anyone on this call is interested in learning how you might avail yourselves of the work that we've done in these areas to do a quicker project than one of our bespoke consulting projects, I'd be happy to talk with you about that. I've got my contact information coming up, and feel free to link in with me or send me an email to ask me about those.